Welcome, everybody, to the Halftime Report. I'm Scott Wapner, front and center this hour, navigating the choppy and more volatile markets with the investment committee. Joining me for the hour today, Joe Terranova, Jenny Harrington, Steve Weiss. We're all here at Post 9 today. Do want to check the market. We have been choppy. We have been a little volatile, but we're green right now across the board, led by the NASDAQ, which is up a little more than 0.25%. We have a lot to talk about because there's a lot going on in these markets, as you know, and we're going to do that with the committee in just a minute. But I do want to bring you a story that is new at noon, and an important one at that, because there was news this week that OpenAI was in talks to raise $6.5 billion at a $150 billion valuation. I'm told from sources that that funding round, the deal, has now closed. In fact, that sources tell me they raised a little more than $6.5 billion at that $150 billion valuation. That it will be announced in the coming days. The amount, we'll learn about the exact investors. I don't have the table in front of me, of course, but it's already been reported that Microsoft and NVIDIA were among those in talks to take part in that round. And of course, the news a couple days ago that Apple had dropped out. Interesting story, Weiss. It goes to the growing power of this company, the meteoric rise of this business, which is now going to be a for-profit enterprise, right? The changes that we've seen at the very top and near the top over the last week or so. But this is a big deal that this funding round, I'm told, has now closed, and we'll learn officially in the coming days about that.
Yeah, so I was actually shown a piece of the transaction, of the deal, and passed on it. And the reason I passed on were a few things. Number one, I still think it's in the hype stage, and number two, their operating metrics aren't great. Now, in earlier stage companies, and this is an early stage company, no matter how many times we've heard about it, I just thought it's too difficult to pick the winners and losers. Now, it's very expensive, extremely expensive, to put out the kind of products that they do. So, so I get that. So that's a moat around their business. But nonetheless, what are you willing to pay for it? Now, in terms of Microsoft and NVIDIA investing in it, I couldn't count the number of $50 to $100 million checks that NVIDIA has written to earlier stage startups. We look at Figure.ai, where they invested, where Microsoft invested, wrote big checks. Actually, Jeff Bezos invested. They have no revenues. They've got I'd call a spec contract with BMW, but other than that, there's nothing there. And they put a value in that of, I think it was $1.2 billion. We also passed that. I'm not saying it won't be a great company. It's got a good founder, but the point is that it's fever pitch for AI, and the valuations you're paying now, you're going to have to wait a long time for those companies to grow into them, in my view. But I take a more conservative view on investing in tech until the clear winners and losers, there'll be a winner to some degree, really, really are visible.
Well, I mean, I'm told, and this is not, some great revelation, of course, that demand was obviously off the charts. That they don't need Apple to invest. The more you have these hyperscalers investing, the more control you give away, right? So these are all things to consider as we all kind of marvel at what this company has been able to do in what feels like a pretty darn short period of time.
So first of all, congratulations to Sarah Fraser, who's the CFO there. She used to be at Square working with Fryer, working with Jack Dorsey. This is a historic growth rate for this company. You're talking about a company that is projecting revenue at $11.5 billion next year. That's triple where they are right now. The following year, you're talking about $25 billion in revenue. That type of growth, we haven't seen that at Facebook. We haven't seen that at Alphabet. So this is something, I think, that's very monumental. I think it's something that is very real and tangible for the investment community. I think institutional investors are going to be clamoring to get a piece of what's coming.
Can you imagine as we talk about the IPO pipeline and the way that, or the different way now that we're going to think about the prospects of this company, what they're going, wherever they go public, whenever they do, the scene that's going to be, and the amount of money that they're going to be able to raise, the valuation that they're going to go public at is extraordinary. You'll put it up there with the best and biggest of these technology companies ever.
Yeah, and just to be clear, I'm not criticizing the fundamentals, nothing like that. It's been extraordinary, to Joe's point. This is just my view and my discipline in how I look to invest in the private markets. So there's scarcity value that actually raising $6.5 billion is not a huge feat when you look at the demand that's around. And it's
no, the bigger feat is the $150 billion.
Right,
right. Let me be clear.
Which right now is 30 times revenue, right? You can't do it on an EBITDA basis because there is no profitability here. 30 times revenue, that's high. That's beyond what I'm willing to invest in at a company.
It's high relative to what some of the, some of the mega caps went public at.
Right.
It's high, but it's not like crazy.
No, because if you go next year, then that comes down quite a bit, and you go the following year, that comes down quite a bit. But the cost side is what you have to watch here, right? It's not getting cheaper, it's getting more competitive. And let's not forget, they lost a lot of very senior people. Nonetheless, if it's what you do, if you invest at this level, if you're a VC firm, look, I know somebody that went in initially and keeps adding, is added every round, including this round. So that's a different perspective. I don't have that VC perspective.
So let's go to the markets. We've had this volatility because of the Middle East. We're probably going to have more because of the economic data that's still to come. Obviously, Friday's jobs report looming large. The election in less than 40 days, I guess. Jenny, most continue to say the trend is intact, that this is still a buy the dip market. Do you have any reason to take issue with any of that?
I do. Of course I do. So let's think about what that means. If the trend is intact and we just ended the third quarter up 21%, that would suggest that we end the year up 28%. If we end the year up 28%, S&P's at 6174. On forward earnings, that's a 23 times multiple. That doesn't seem that reasonable to me. So if you take that trend, the broad market trend, I don't know that that trend is intact. I think if you look beneath the surface, perhaps you can find a trend that might be intact. And it was an interesting quarter. There was just incredible leadership rotation. And I think it was leadership rotation in a much healthier way than we saw it in 2022. For example, and this is like my perfect, here's how to distill it. Utilities are up 30% on the year. Tech is up 30% on the year. Utilities are up 19% in the quarter. Tech was up 1.6%. So beneath the surface, that trend, that part of the trend where we see leadership rotation, perhaps that could continue. That I'd be comfortable with. I also like the kind of rotation that we've seen in leadership there because it's not one, and throwing out the other. Almost every sector was positive on the quarter except energy. And so what you just saw was the leaders lagged but didn't fall off a cliff. The laggards led, and it was healthy. It was a broadening. So if we think of that part of the trend intact, yes, S&P up another 8%, 7% for the end of the year seems implausible to me.
So Oppenheimer today argues buy the dips. They suggest, Joe, that the highest percentage of NYSE stocks above their 200-day average since July, that's what's being supported here, that typically rallies with more stocks participating are the rallies that continue. That's not a massive leap to make either, but in other words, the trend is supportive.
It is. And you do want to buy the dips. And you've got global central banks that are all supportive of risk assets. I think the real trade is happening in large caps. That's where the broadening out has occurred. What's glaring to me is that if we think about what unfolded in September, it really was a sell the news moment for both small caps and bonds. And that's important to think about. The low for yields was 359 for a 10-year leading into the announcement from the Federal Reserve. The low for a 30-year was 3.88. I believe we're somewhere around 4.15 right now. So that lends itself to staying high up in the equity size class. That lends itself to technology, once again, making the return like we're seeing here early in October. And I think the overall playbook for 2024 that's been in place is the one that investors want to stay consistently adhering to and having the discipline to maintain positioning.
Weiss, buy the dip. We still intact? Path of least resistance upside?
Look, I think there's going to be continued volatility through the election, and we've increased the chances for something negative happening with the labor strike that we're seeing with the Longshoremen's Union, which, by the way, has not come out and endorsed either candidate. So are they going to play for that, number one? Number two, clearly it'll be inflationary. 25% of all goods come through those ports. Sure, you could ship around to the West Coast, but that adds 30 days. So I think that's an issue. And then what's happening in the Middle East? Israel is going to retaliate. The question is, will it be on the oil complex there, which is easier than going through their nuclear capabilities? Because you can't get to those nuclear capabilities without using, most of them, without using a nuclear bomb yourself, because they're so deep down. I don't think they go after oil, because if I'm sitting in the White House, I'm saying stay away from oil, because that'll be immediate inflationary, while the rest of the Middle East is having problems, adhering to quotas, and Saudi said we're giving up on it. They would love them to go after Iran's oil complex. They being, I think, the second largest in OPEC and third behind us. So there's really a lot that could happen here, but it's not going to end today with Iran saying we're done. This is a once-in-a-generation opportunity to get them back into, into a manageable situation. Look, Israel went after Hezbollah. They went after Hamas. Who funds that? Iran. So it's likely they'll make a statement by going after them, in my view. So all that leads to volatility. What's kind of interesting is that the market is trading up today after trading down yesterday, because yesterday was sort of like a minor move. So you buy geopolitical issues, I firmly believe.
Well, because we've seen before, obviously not to minimize the events in any way, shape, or form. I'm speaking from the market's perspective, not any personal thoughts or anything related to that. The market has generally viewed that kind of thing as noise.
True. But and I agree with that 1,000%. But here's why it's different. It's different because we are so focused on inflation and so focused on the Fed. We've borrowed performance from Fed further easing in the Fed. So if they do go after oil, that's inflationary. If the strike continues to go, that's inflationary. But specifically in the Middle East, it's not like taking out capability, the infrastructure in oil before. This is different because if inflation pops up, will the Fed go? So, I sort of think that'll be transitory and they'll go anyway, but I think the market is just, whistling by the potential graveyard in that. So that's why I'm cautious right now through the election.
I think this is one of the times when it's particularly hard to be an investor because you have all the noise, right? All the noise from the elections, all the noise from the Middle East, Russia, Ukraine, and then you need to put on your cold, hard capitalist portfolio manager hat. And this is what I'm struggling with writing in my letter to clients. Literally right now, what I'm struggling with is how do you sensitively say, yes, there are really terrible things going on in the world. We're all upset. Whatever side you're on, you're upset right now. It's terrible out there. But as it impacts the U.S. markets, it's really nil. And even with respect to oil, Saudi said, hey, we're going to pump. And that, we saw oil drop from $75 a barrel down to a little below 70. Now it's rallying up, but it's still in a very manageable range. We also have the shale that can dial it up. So I think it's really hard to tune out all that noise and just look at the fundamentals of
I know, but I thought that's what, people are, like you guys are supposed to do, right? Tune out the noise and focus on the big picture, which is once again being distilled down by some who watch and, guide people through the markets that the Fed's cutting and the economy is good, that's why they would suggest ignore the noise, focus on that. Distill it down to what's the most critical piece of information that you need to know as an investor. And it's that the Fed is cutting and the trend is just starting and the economy is actually still doing pretty well.
And that's right. And so in this market letter where I am now is set that noise aside. Here's what matters. The Fed is cutting and earnings are still strong and earnings growth is still strong. And that's where we started the year off too, thinking like, why would the market go up this year? Because interest rates are coming down and earnings are going up. Those are what underpin a strong equity market. Now, that being said, when I say I don't really see how we get another 7% growth, which maybe we will, I'm often wrong on that. But when I say that, I just think that this market has pulled forward a lot of the return year to date, right? We went into this year expecting interest rates cuts. We finally got them. We went into this year fully expecting 15%-ish, maybe it's 12% earnings growth. We're getting that. So I just think when we're at a plus 21% on the year, I think we've pulled a lot of that great economic news into the spot that we're sitting in.
Are we making too much, Joe, of the market's valuation, which is 21.5 times, right? It's 1.5 times standard, 1.5 standard deviations above the long-term averages. However, it's skewed so much by what's happened with the mega cap stocks that these other 493, whatever, are so less extremely priced, as UBS tries to make the argument today, that the market's going to continue to broaden, tech's going to continue to lead, and valuations are likely to move higher.
I kind of agree with all of that, and I'm not surprised so many try to utilize valuation, what they perceive as a rich valuation, as a reason to reduce holdings, to sell positions. When I look at everything that's in front of us right now, yeah, I see the trouble signs. I see the potential elevated volatility through the election. I see the concerns in the Middle East, but I also see that the price of oil, as we're speaking, is $70.15. To me, that's somewhat astonishing. Based on what we know about the Middle East, oil should be closer to $80. So I think that the conversation, the sweet spot of it needs to be the ability of tech companies and AI adjacent companies to grow their revenue, not at the rates that they've grown it over the last 6 quarters, because that's been somewhat historic, but grow it enough to where shareholders continue to pay the premium that they have been paying over the last 6 quarters. That sustains the momentum. The biggest issue that I would have, the biggest obstacle for the market through the remainder of the year is, in fact, if we see the inability of these companies to meet those expectations. And if we see the earnings begin to decelerate at a pace that makes shareholders uncomfortable. To me, that is where you see the market reverse the prevailing trend and have that corrective behavior.
Can we talk about that for 1 sec? And so what I think is
I'm not the host.
Okay, sorry.
Yeah, go ahead.
Thank you.
Go ahead.
So if you look on the
Taking care of
subject,
some business, go ahead.
Okay, on the subject, yay. On the subject
Keep
of
going.
earnings deceleration, the Mag 7 went into this year with year-over-year earnings growth of 50%. They will leave this year with earnings growth year-over-year of 21%. So their earnings growth is dramatically decelerating. Flip that, look at the ex-Mag 7. They started the year with year-over-year earnings growth of -2%, and they'll end the year with plus 13%. So I think you bring up a really interesting point, which is we know earnings growth for the Mag 7 for the mega cap tech is decelerating. But how you phrased it, Joe, was that investors are comfortable with. And I think at this point, they're still comfortable with that level of deceleration. I look at it, I see an opportunity, because when you look at small cap too, small cap went into the year with -9% year-over-year earnings growth. They'll leave the year with plus 20% year-over-year earnings growth. So like that's really going to be what gets fleshed out this quarter, is where people's comfort is and where people's excitement is with accelerating earnings growth trends and decelerating earnings growth trends.
I also think it's how risk averse both retail and institutional investors in an environment where we're seeing elevated volatility. What's the willingness to look at the risk to reward scenario and to accept the risk for the potential reward? In some of the areas that you're talking about of the market where you've seen underperformance and they've yet to prove themselves with earnings growth.
Okay. Do you think we have a lower bar if we're talking about earnings growth? If you think the bar is lower for mega cap stocks because of the broadening that we've had? I find an interesting note today from Goldman Sachs on the rotation and what's going to happen in earnings season, where they make the argument, and they talk about both, okay? Recent experience has reaffirmed the notion that the U.S. market can run on multiple engines and has supported the case for some diversification across segments. This dynamic makes the risks more balanced going into the Q3 earnings season in a couple of weeks. A lower bar for mega cap tech opens upside paths that there were harder to envision in Q2. What do you want to do with that?
So I'll acknowledge
broadening's good for all.
Yeah. So Scott, I'll acknowledge that there's a lower bar for a lot of these technology companies to exceed, but I look at the tape yesterday. So yesterday, the quality factor outperformed the market, but yet what we perceive to be quality, which is the mega caps, which is these trillion-dollar technology companies, they actually underperform the market. So you ask yourself the question, why is that? because positioning is rather full in that area of the market, and they were somewhat an ATM, a source of funds yesterday on a day where it was clear that investors wanted to move away from risk. So I think as we move into this critical earnings season, you have to look at the positioning and say to yourself, there needs to be enough there where investors, where shareholders don't get uncomfortable with the deceleration, because at that point, you're really talking about the type of positioning that's rather full in that area of the market. And that leads to, again, the sell-offs.
And I think it's interesting too, because I don't have a sense going into this quarter. When I read that piece from Goldman, I wondered, why are they guessing that? Because I don't have a sense of where the bar actually is. And if you take just NVIDIA is down 8% in the last quarter, right? The last 3 months. Bristol Myers is up 35%. So where is that bar? What is a low bar? I'm not sure.
NVIDIA's down 3% in the last 3 months.
Oh, okay. Sorry. I thought I said 8.
8.3. It's down.
It's down. And that was after spectacular earnings, extraordinary earnings.
Hey, by the way, Jensen Huang's going to be on overtime today. It's a big deal.
That's a big deal.
The NVIDIA founder CEO, Jensen Huang, is going to be on overtime today. It's a CNBC exclusive with Julie Sweet of Accenture, the CEO. I just wanted to make sure we mentioned that. Sorry, didn't mean to interrupt.
But I think it's interesting going into it where I don't have a sense of where the bar is actually set after last quarter. I think only time will tell. I really want to see what the mega caps report and where people actually stand.
Let's move for a minute before we take a break. I know you all have seen Nike. It's a mess. I don't know what else you say. I mean, it's down 23% year to date. It's the second worst Dow stock next to Intel. So they report last night, they withdraw their full year guidance. They postpone their investor day. Bernstein says no CEO, no guidance, no investor day. Nike is deep in the abyss of the turnaround. What I find so interesting, it's so bad, apparently, that even Stephanie Link, who loves a good turnaround story, says she won't touch it. Listen.
So Hoka and On grew revenues 25 and 29% their last quarter. Nike's going to fall 10% this quarter. I don't think the quarter really matters. I think it's de-risked. It's all about guidance. Do they pull it or not? But market share losses are significant. It's going to take a long time for this turnaround to work.
Okay. 4 price target cuts, 1 price target increase. Joe, we have no huge, rating changes from the firms, but this thing seems like it got bad pretty fast.
Well, it did, but I also think the company did what they were supposed to do yesterday, which basically, it's the proverbial kitchen sink the quarter, and look towards the future and say, okay, we're going to reset everything at the lowest possible level. That's not a reason to buy the stock. It's never a reason to buy the stock. You buy the stock when the evidence is there and you hear the confidence from the C-suite on an earnings conference call. You didn't hear any confidence at all. So I don't know. I look at the environment. I look at Nike where it's trading. I got burned on it several months ago. I'm not going to step back into it. And candidly, I would probably, I know that it's not a straight comparison, but I probably would buy Lululemon before I'd buy Nike at this point.
There's a lot going on here. Number one is they went more to an online presence. So if you went to Foot Locker, where it used to be shelves and shelves of Nike sneakers, now it's got the On, it's got the Hoka, it's got New Balance, more Adidas. So instead of being in a position where they're defending their shelf space, and this is true, supermarkets, true of all retail, now they've got to go back and take it back. And so when you're seeing, how I don't think Hoka is really a sustainable brand, because I'm not a fan of it.
Really? The best thing ever.
Talk to the younger generation.
So now the point is,
if you're the litmus test on any level of fashion, we're all in deep.
Right, because I'm not.
Okay, obviously.
You're right, because I'm not with the masses. I'm a fashion trender, rather.
Yeah. Okay.
I said trends.
What are those that you're wearing anyway?
The bottom line,
Smith's,
though,
baby.
The bottom line is, besides the big move into DTC, right, direct to consumer, they obviously relied too heavily on the Jordan part of their business, Dunks, and whereas the Hokas, whether you like them or not, or the Ons were perceived to be innovating at a faster clip than Nike, which was resting on its laurels and depending on the past to continue to drive the energy in the brand.
Yeah, exactly. And the rise of Jordan, at some point when you overproduce as they did with the Jordan brand, you decrease the scarcity value and you decrease the interest in the consumer wanting to go and buy it. So those high prices you can't get anymore. And since that was really what was helped driving a lot of the recognition of the brand today versus 15 or 20 years ago. My view on Hoka, though, is that it's an athletic shoe. That's what it is purely. Whereas On is more of like an all-round shoe. You can wear it everywhere. So I think it's got limited growth in that respect.
Okay.
So the margins don't.
Aging feet like Jenny, then it's very comfortable.
And just to be clear, my husband refers to my Hokas as my orthopedic sneakers.
Exactly.
All right, margins don't lift though when you have to chase market share because you're spending money.
Yeah.
Okay. JP Morgan says it's time to take a breather on one high-flying stock. Joe owns it. We'll debate it when we come back. Downgraded today to neutral from overweight. JP Morgan, time to take a breather. They suggest limited room for consensus upside. They do keep the price target $2,400, Joe.
All right, so let's set the expectation for the viewers on this position. First of all, in the JOTI ETF, it's been a holding since April of 23. I cite that because we have a 54% gain. So we have time on our side. We could be patient going through what a period looks like where margins are going to compress. They're going to compress because they're spending, building out distribution centers, spending on logistics. The credit card business is seeing some challenges as well. So you're going to have a period where this might be a pause that will ultimately refresh. I like the e-commerce theme. This is a $104 billion market cap company. It joins Amazon and Coupang in our ownership of e-commerce. Be patient. Ride out what potentially is a margin contraction period.
Rio Tinto, Jenny, got upgraded to buy at Berenberg. What an economic moat really looks like is the commentary from their thing. Price target goes to 79 from 71.
So with Rio, it's really all about the iron ore, and right now they're selling it at 109 a ton. That's down from the 144 in January, but when they talk about that moat, that's because it costs them $22 a ton to produce. So it's extraordinary. They have almost no debt, which puts them in a great position to make acquisitions. And here are the valuations, which are pretty insane. Trading at 10 times earnings, 5 times EBITDA, has a 6.1% dividend yield, has a 7% free cash flow yield. So we own this in our international income strategy, and we love owning it in there because it's a way to play China without actually needing to own Chinese stocks. This is just a quick aside, but there was a headline from Goldman this morning that said hedge funds made record purchases of China shares. And to us, when we hear that, it's hot money flooding into the Chinese shares, not real investment into those companies. So for us, playing Rio is a nice way to actually participate in the growth of China without getting caught up in Chinese stock shares.
Apollo price target raised to 142, reiterated by Bank of America, Joe.
The alternative asset managers right now are seeing very strong tailwinds. In the case of Apollo, you're talking about a company that's raising nearly $150 billion through 2029. In this space, we have ownership of 4 names that are performing very well. Obviously, we own Apollo. In addition, we own KKR, Arch Capital, and Brown & Brown. You could also look towards Evercore, which is up 47% year to date. Surprisingly, Blackstone is struggling, and I'll throw out another name, which is Blue Owl Capital, trading at around $19, doing well, and congratulations to the co-owners of Blue Owl, who just closed on the Tampa Bay Lightning yesterday, $1.8 billion.
Okay. Berkshire price target, 512 from 488 by CFRA. You want to take that one?
Listen, Berkshire is so good at finding quality and value in the market. I would imagine that they were first in identifying opportunities in Japan. We've seen recent weakness in Japan. They'll take advantage of that as well. Then in the energy space, we just learned a utility that was previously held at 92% by Berkshire. They just bought the remaining 8%. Berkshire Energy did. The estate of Walter Scott, that's where they got the other 8%. So they're just able to realize value in all environments where there seems to be weakness, price weakness.
Carrier Global, Deutsche says catalyst sell call. What do you think, Jenny?
So this is
That's their short-term rating. The target's $70, $10 below where it is now.
Yeah, so this is a really tough one for us. We bought this in 2021. We paid $37 a share for it, and it was trading at 17 times. Fast forward now, it's at 27 times, and we actually trimmed it about 2 weeks ago now on the 20th. We trimmed it when it was about 80.5. We took it from about a 5% position back down to a 3% position for exactly these reasons, that it just moved up too fast. Management spoke at a conference, and there was so much enthusiasm that the stock took another leg up. So here we sit, and we're like, this is a great company. There's huge wind at the back in terms of the world broadly using more air conditioning. In the U.S., people wanting more and more efficient air conditioning systems. So there's huge growth, but the valuation's a stretch. So we're kind of on the fence with our 3% remaining position, and don't disagree with the sell rating.
All right, the trade desk, some optimism here, Joe, from Truist and Dan Ives. Truist goes to 120. Ives goes 115. They're both obviously constructive on this name, and I think you own this.
Absolutely, and they should be constructive on this name. This is coming up on now 2 years that we've had this holding based on the momentum factor more than anything else in the ETF. So momentum is not just cyclical, Jenny, it's secular as well. I'm very surprised that this company has not been added to the S&P 500. That was the expectation. It grows its revenue at 25% over the last 3 years on a consistent quarterly basis, and has a very strong share of the digital ad market using AI. $53 billion market cap. I wouldn't be surprised if someone buys this company at some point.
All right, Silvana now. Coming up, we do have a fresh committee move to tell you about. Steve Weiss just bought a healthcare stock today. We will discuss when we come back. Let's pull up shares of Humana because this is the worst day, I think, in a couple of decades. They had a drop in the Medicare Advantage quality ratings, and that is a big threat to revenues. Stock's down 16%. It was down more than 22%. You bought it, Weiss.
I bought it on the news, so it's actually been a good little trade. I'm only going to be here for trade.
Like what, like 10 minutes trade?
I drive it. No, it's been longer than that, actually.
No, but you know what I mean. Like,
no, but
here's my problem,
right.
Okay? I want you to give as much context as you think you can give.
I'll give it.
To how long you think you'll be there, because if we're mentioning it on the program and then you say it's for a trade, which is respectfully, of course, you can do whatever the heck you want to do. I don't want to give people the impression that this is something that's going to be around for a while. What does that mean?
Okay, so if it continues to move up, so I've got a lot lower cost here. Stock was down over $60 when the news first came out. The news is very significant. Normally, I would buy this and hold it for a period of time, but here's what the STARS rating means. The STARS ratings are what drives consumers to the plan. So if you got a 4-star rating, right, that means you're more likely to go, consumers will be attracted to it. If you have a 3-star, then they're not as attracted to it, number one. Number two, there's also the quality of care measurement. So you can get bonuses for quality of care depending upon where your star rating is. Obviously a 4-star. This in particular, they're talking about the star rating coming down significantly, which could affect 50% or more of earnings in 2027. So right now, 2025 is set, 2026 is set. But here's what they can do. They're appealing Medicare's findings. So they actually knew that there was something going on here. The star ratings were put up by a third party, and we don't know if they're going to be reliable or not. Directionally, they're right. So here's what would happen. By October 10th, Medicare will come out with their star rating conclusion. So you have some runway to that. Additionally, in 2027, there's a lot they can do before 2027, which is make acquisitions to drive revenue. But right now, the stock would be expensive if these star ratings hold, because they'd lose one large contract. So going back to your question, right now, I still think you could move up. But if it gets to be, say, down only $40, I'm gone, because that's a good trade.
$4. $4 difference from here is done.
Right.
Like a percent.
Conversely,
No, it's like 2%.
Exactly. But
so you're playing a trade for 2% wise?
You put a significant amount of shares in it. It's dollars. You see, you use a benchmark. You use a benchmark of what the S&P do. I use a benchmark of how much money am I making.
All right. Here's what we're going to do. Next time, we're not even going to mention it.
It's your call, man.
How about that?
I didn't lobby anybody to
How
mention
about that?
this. I just said.
Next time, we're not even going to mention it. Because it's too confusing for the viewers to figure out, well, when is he in? When's he out?
I only mentioned it. I didn't say I want to come and talk about it, but I give our viewers a lot of credit as they can
I give them
understand.
tons of credit, but you're not going to.
I'm not criticizing what you said. I think that they could say, okay, there's upside here. You know, I gave them the facts. They may think there's more. They may say 25, 26 earnings are in the bag. I'll worry about 27 when it happens, and remediation they can take between now and then. I guarantee you a lot of comments will come out to that.
Okay, that's fair. That's fair. Just want to make sure we're
all aligned. We're 100% aligned.
We are?
Except on Hocus. I prefer stance.
A lot, believe me, a lot of other stuff. I've seen you wear some stuff. We're not aligned fully. Up next, pumping the brakes on China. One legendary investor says he wouldn't touch that monster run in China stocks. We'll tell you who it was, what he said, why, and if our desk agrees. Next. Welcome back. China stocks continue to move higher today. Hang Seng posting its best day since November of 22. Weiss, you see these comments from Stan Druckenmiller? He was apparently at a conference where he was quoted as saying that he has, quote, no interest, quote, as long as Xi Jinping is running that country. It just goes to why some, I think including you for a pretty long time, have said it's uninvestable. You don't trust it.
Right.
Whereas Renaissance Macro's Jeff DeGraff says he's very bullish. If you never listen to another thing we say, listen to number one. Number one was buy China. What are we supposed to do, man?
So we've got three views coming from different places. So Tepper came out. Dave is, he's bullish on the trade, I'd say, because of the stimulus. I wouldn't expect him to be there on a long-term basis. Druckenmiller, he tends to be, I think, a little longer term with equities, particularly now that he doesn't have his hedge fund publicly. So I think he's right from a longer term basis. Intermediate term, it's not investable. Not investable doesn't mean it's tradable. If you go to DeGraff, who I worked with, at a prior shop, he's purely technical. And right now, and Joe will tell you this, momentum looks good. So you've got three different ways of coming at the same, at the same trade, and they all make sense given what their perspective is.
No, but what I find interesting, though, is, as far you know better than me,
Yeah.
Tepper and Druckenmiller are, they see a lot of things the same way.
And they're friends, they're good friends.
They respect each other's investing strategy.
Absolutely.
Arguably more than any other. They're like, they've talked about the way that they invest over the years. I find it interesting that Tepper comes on and says, buy everything. I'm paraphrasing a little bit. Whereas Druckenmiller's like, I'm not touching it. I can only imagine the conversation that they might have had between the two of them, over the last week or so.
Right, but I can tell you Dave's cost, I'm just looking at Baba, is a lot lower than where it is now.
I know, but you know
so
what I
Dave's
mean.
buy everything is conditioned on price. And
obviously.
And you mentioned when he made the comment, he could be out at any time. And with having this kind of gain in such a short period of time, Dave's the kind of guy that maybe I don't want to wait. And I don't know. I've spoken to him recently, but not about this. So I'm not out of school here. But you don't know. You don't know. So the point is, stocks up, in no time.
Right,
from
a lot. Look,
from
the
80 to
K-Web's a 52-week high.
Yeah.
FXI is a 52-week high. No surprise, because they've been like the other day was the best day for China
And
stocks.
Stan was being asked the question after this move.
Yeah.
Don't forget.
Yeah. Two Pittsburgh guys, right?
Yeah.
All right, final trades are next. Give me a final trade, Weiss.
PSQ, which is short the NASDAQ, take out some protection.
All right, Jenny.
Organon, back to 6% dividend yield.
All right, Joe T.
An industrial name, Howmet.
Okay. Thanks, everybody. I'll see you on the closing bell.